Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Twitter stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Twitter is a microblogging and social networking service where people post messages known as tweets. Tweets were originally restricted to 140 characters, but the limit has doubled to 280 in 2017. Audio and video tweets are limited to 140 seconds. There are about 400 million users on its platform. The big news recently is Elon Musk bought 10% of Twitter stock, and he also received a seat on their board. The company is headquartered in San Francisco, California, and was founded in 2006. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, Euro TLX, Swiss, Sao Paulo, Buenos Aires, and Kazakhstan. Let's get started with the model. This is a large cap company, 42 billion market cap. They're trading at $52 a share, and they have 801 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow seems to be going down each year from 856 million to negative 379 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 2018 and 2019, negative in 2020 and 2021. Revenue is the sales for the company, and that grows each year, growing a lot from 2020 to 2021 at over 5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses to maintain their platform are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in 2021 at 3.3 billion. Below that is their operating expenses. They spend a lot in research and development and also marketing. Gross profit minus operating expenses gives you your operating income. That was a lot higher in 2021 compared to 2020, but lower than 2018 and 2019. They spent 51 million of interest on their debt, which is a lot lower than prior years, so it looks like they're paying down debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. When you see a big negative, it's usually an asset impairment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is their net income. The reason it's negative in 2021 was this large loss in other income and expenses. I would just focus on operating income when I look at the income statement, not net income. And the reason they had such big gains in 2018 and 2019 was due to these large tax credits. A tax credit of 780 million in 2018, over 1 billion in 2019. Their pre-tax income was 390 million, but with a tax credit, they reported net profit of close to 1.5 billion. But they paid over 1 billion of taxes in 2020 with a pre-tax loss of 50 million. This is the company's income statement from their 10K. And their revenue was over 5 billion in 2021, a lot higher than prior years. Most of their revenue comes from advertising services. They sell ad space on their platform. That was 4.5 billion. Then 600 million from licensing. The good thing about this company is they generate revenue from all over the world. 2.8 billion in the US, 675 million in Japan, and 1.6 billion from the rest of the world. Their cost of revenue is 1.8 billion. That gives them a gross margin of 65%. Gross margin is gross profit over revenue, which is higher than their industry average of 53%. The median is 57%. They spent over 1.2 billion in R&D, 1.2 billion in marketing, 584 million in general and administrative, and they spent 766 million in a litigation settlement. The litigation is from the third quarter of 2021. They settled a shareholder class action lawsuit. This is common with big companies dealing with lots of lawsuits. The shareholders claim the company painted an overly rosy picture of its future, which pretty much every company does. The lawsuit said Twitter misled investors over the company's growth prospects. The company promised that monthly active users would increase to 550 million in the near future. And obviously Twitter did not deliver on that promise, so shareholders were upset. If it wasn't for this lawsuit, they would have had positive net income. The company does not add many shares. They had 770 million, then 788 million, then 798 million. This is their statement of cash flows, and the top line is operating cash flow. That's how much cash the company generates from its operational business. And that's going down each year from 1.3 billion to 600 million. They spend a lot on CapEx each year, over 1 billion in 2021. Most of that is equipment and capitalized software. Operating cash flow minus CapEx gives you your free cash flow, and that was negative in 2021. So it looks like they added about $500 million of debt in 2021 to fund their CapEx. But they also bought back over 900 million of capital stock in 2021. So they must have had a lot of cash left over from prior years. They added about 1 billion of debt in 2020. They paid down a little debt in 2019 and added about 1 billion in 2018. This is their operating section from their statement of cash flows. And the way you calculate operating cash flow, you start with your net loss of 221 million. Then you add or subtract the non-cash items on the income statement, adjust for changes in working capital, and you get 633 million. So they did generate positive cash flow, mainly because of these large non-cash items. Depreciation and amortization, 544 million. Stock-based compensation of 629 million. They passed through a large deferred tax asset in 2020, so we add it back here on the statement of cash flows. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. Their revenue grew a ton in 2021, but their operating cash flow declined a lot. There seem to be a lot of one-off items in 2021 that are not likely to recur in the future. So I think their operating cash flow should be fine in 2022. I don't think it's going to continue declining. This is their investing and financing sections of their statement of cash flows. In their investing section, they spent 1 billion in property, plant, and equipment. They bought 3.7 billion of marketable securities and 3.8 billion matured. And they also sold 1.2 billion of marketable securities. These are short-term liquid investments, so they're pretty low risk. In their investing section, they had a cash inflow of 50 million. Last year was a cash outflow of 1.6 billion. In their financing section, they raised 1.4 billion of convertible notes. They bought back 950 million of convertible notes, and they bought back 930 million of common stock. So they had a cash outflow of $500 million in 2021. Last year was a cash inflow of 755 million. This is the equity section on their 12/31 balance sheet. They have 7.3 billion of equity. They raised 8.4 billion from selling their business, and they lost 1 billion from running their business. But I think they're cash flow positive. A lot of the items on the income statement are non-cash, so they bring down their net income. Because that's what accumulated deficit is. It's a sum of all the company's prior net incomes. Let's look at their capital structure. 7.3 billion of equity, 5.5 billion of debt. They're 57% equity, 43% debt. And they could pay off all the debt with the cash on their balance sheet and still have 847 million of cash left over. You can see their equity balance went up from 2015 to 2020, but it's come down from 2020 to 2021. They have a ton of cash on their balance sheet, a lot higher than their debt, but their debt balance is increasing as well. It did go down in the last half of 2021, but their debt balance peaked in the beginning of 2021. I gave them the highest whack on Finbox, 7.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 52 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $46 billion. We divide that by 801 million shares. And we get a calculated stock price of $57. They're trading at $52, so they're trading at an 8% discount. It's a buy according to the model. Their revenue is projected to hit 8.6 billion by 2024. So I grew their revenue 19% to get to that number, and then another 19% into 2025. That's how I got their future revenue estimates. In 2018 and 2019, they converted 25% of their revenue into free cash flow. So I multiplied their future revenue estimates by 25%. That's how I got their future free cash flows. And all these numbers are a lot higher than prior years. So it is possible they don't hit these targets. And if that happens, then the stock does appear overvalued. But if they continue growing their revenue like they did in 2021, the stock has a lot of potential, especially now that Elon Musk is on the board. The website Simply Wall Street's valuation is $85. That's saying it's 41% undervalued. 28 analysts priced this stock and the average is 46, the lowest 30, the highest 60. This is where the stock has been trading the last 5 years. So it looks like it peaked at about 77 in the beginning of 2021. Then that price was cut in half, but it has come up recently, especially with the news about Elon Musk. The stock has shot up a lot. In the past 5 years, the S&P 500 is up 95%, while this stock is doing much better, up 265%. So if you bought this stock or the S&P 500 5 years ago, at any point in time, Twitter would have been beating the S&P 500. They have a low beta, 0.8, so the stock is not too volatile. It's gone down 25% in the past 52 weeks, while the S&P is up 12%. The 52-week low is 31, the high is 73. And the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. Over 40 million shares are traded each day. Of the 800 million shares outstanding, 779 million are on float. 78% are held by institutions, and 5.5% of the shares are shorted. Their employee count has been going up a lot the past 2 years. They currently employ 7,500 people. If you invested $10,000 into this company 10 years ago, at one point you would have been down to about $3,500. But if you're still holding on, you'd be at $12,000 today. That's only 2% annual return. In the past 12 months, there's been more insiders selling than buying. But one person bought 2.1 million shares, and if you combine all the sell orders, it's much lower than that. Here's a list of all the insider buying and selling, the date, the person or company, the shares, and the price. 76% of the company is held by institutions, 21% by the general public, and 2.5% by individual insiders. Elon Musk is the biggest shareholder, but the top shareholders on Simply Wall Street hasn't been updated for several weeks. According to their chart, Vanguard is the biggest shareholder at 9%, then Morgan Stanley, BlackRock, State Street, and Aristotle. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is 8.3, that's stock price over sales per share. Price to book 5.8, that's stock price over book value per share. And we can't look at their price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. $2 billion of property and equipment. That consists of $2.6 billion of equipment, $500 million of furniture and leasehold improvements, about $1 billion of capitalized software, and $260 million of construction in progress. The gross value is $4.3 billion, and $2.2 billion has been depreciated, so the net is $2.1 billion. They lease $1.2 billion of assets, so they carry that as an asset and liability onto their balance sheet. $69 million of intangible assets. That consists of $48 million of patents and developed technologies, and $21 million for their workforce. They have $1.3 billion of goodwill. Goodwill is the premium you pay when you acquire another company. $1.1 billion of deferred tax assets. This will help decrease their taxes in the future, and $344 million of other. Let's look at their non-current liabilities. $3.6 billion of convertible notes. This debt may convert to equity if their stock price goes up to a certain point. If that happens, then they remove all this debt from their balance sheet. $690 million of senior notes. $1 billion of operating leases. The assets tied to these operating leases show up in the company's non-current asset section. $41 million of deferred tax liabilities. This should increase their taxes in the future, and $44 million of other. They have a pretty low return on invested capital of about 3.5%. They can cover the interest payments with their operating income more than 5 times. They have a negative ROE since they have negative net income. They have a high current ratio and quick ratio, close to 6. Let's look at their current assets. $2.2 billion of cash, $4.2 billion of short-term investments. The $2.2 billion is broken down to $337 million of cash, $1 billion of money market securities, and $848 million of corporate notes. The short-term investments are U.S. government securities, corporate notes, and marketable equity securities. All really liquid, low-risk assets. They have $1.2 billion of accounts receivables. This is how much money others owe them. They have $266 million of prepaid expenses. This is when a company makes an upfront payment for a product or service they're going to receive in the future. And $41 million of assets held for sale. So these assets they plan to sell within the next 12 months, and they're not being depreciated. Let's look at their current liabilities. $200 million of payables. This is how much money they owe others. $918 million of accrued and current liabilities. Accrued liabilities are expenses the company has incurred, but it hasn't paid it yet. And they owe $220 million on their operating leases. This is owed within the next 12 months. In 2021, they had negative $379 million of free cash flow, but they have $6.6 billion of working capital, so it does appear the company is well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 72 companies in the same industry as Twitter, and Twitter ranks 6th in market cap. They're a little larger than the average. They spend more on CapEx than the average company. Their debt to equity ratio is worse than average. They have negative free cash flow, so that's worse than average. All their price multiples are worse than average. Their 3-year annual revenue growth rate is 19%, which is good, but it's lower than average. So to summarize, I have them trading at an 8% discount, and this company's been getting a lot of press this week, mainly due to Elon Musk. My main concern is the stock price will decline after the big run-up, because the run-up is not due to their fundamentals, it's just due to Elon Musk. Maybe Elon sees something great in this company and the stock price does deserve to go higher and higher. I could definitely go either way on this one. I ranked their free cash flows 3 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.